Dear all, welcome to the class of International Economics. So we are moving to the last module of our International Economics syllabus, and it's on balance of payment. So we will be dealing different concepts and also different accounts of balance of payment in this first class. So this is the part of international economics. So one module we have already covered on exchange rate and its theories. So in this video we will be covering different concepts related to balance of payment. Firstly, what is balance of payment? There is a definition by Kindleberger. It says that the balance of payment of a country is a systematic record of all economic transactions between the residents of the reporting country and the residents of a foreign country during a given period of time. So this is the definition given by Kindleberger. What he says, it is a systematic record of all economic transactions between two countries. So in simple words we can say like that: systematic record of all economic transactions, okay, between two countries. I mean, as in the modern world, we know that all the countries are more or less open, and they have more interactions and transactions with the other countries. So in this scenario, if you are recording all these transactions for a particular period, or normally it is 1 year or financial year, so if you are aggregating all this record, it is called as balance of payment. So the balance of payment includes each and every transactions of one country with another country. Okay, that transaction might be done by any particular individual in one country with another persons in another country, or it can be the transaction of a one government with another government, or a transaction of a one firm with another firm. Okay, it can be in different ways, but all the transactions are included in balance of payment. Okay, so that's why we are saying balance of payment is a systematic record of all economic transactions. Okay, what is the need of all these transactions, or what is the need of all these records? Why do the government need to keep all these records? There might be several reasons. Each country will have some internal objectives and some external objectives. Suppose like one country may have some kind of objectives like economic growth, then employment generation, or inflation targeting, or reducing the inflation, or external balance. So these all might be the different objectives of a government. So if they want to satisfy, or if they want to fulfill all these objectives, so they need to start, or they need to adopt some kind of monetary or physical or any other external or trade policies. So if they want to adopt these policies, they want to record of all these transactions with other countries. Okay, so these records will help a country for the formulation of different policies. That's why they are keeping these records, and according to that only they are adopting different policies. Then as we said in the definition, it is the aggregate of all transactions. It is not a transaction of any particular individual or a particular firm. It is an aggregation of all data. So if you are compiling all the data, or all the data of all transactions, we will be getting balance of payments. So we can say that it is an aggregation of all the economic transactions. Okay. Then these economic transactions might be in different ways. Suppose a country has to deal with other countries in respect of several transactions, like the transaction might be in visible items, or it might be in invisible items, or it might be capital transfers. Okay, transaction in visible items, for example, Rubik's Cube, which is the top selling toy in the world. So this might be one kind of transaction, or I can export this Rubik's Cube to any other country. Okay, then this is a visible item and tangible item, and I can export this. Okay, so this includes in the export of visible items, or it can be invisible items, like the service of a doctor. It cannot be it is not tangible, and it is not visible also, but there is a service. There is a export of service and import of services. Then there is a inflow of income and outflow of income, or there might be some services like insurance, banking, and these all are invisible items. So this invisible item also part of balance of payment. Then it might be capital transfers. You might be heard about FDI, FII. So each country might be investing in some another country. It might be through the FDI, foreign direct investment, or foreign institutional investment. So okay, all these investments, or long term, short term debt, or lending, borrowing, all this includes capital transfers. So this transaction might be mainly either of visible or invisible items, or through the capital transfers. Okay, so in the accounting principle, how can we generate the data, or how can we clearly keep a record of all systematic transactions? There is an accounting principle for that. So if you have some idea of commerce, some of you might be from commerce background, so you know that what is debit and what is credit. Normally all the people know that debit and credit. Okay, so economic transactions always will be recorded as credit or debit, right? But we have also heard that all what comes in is credit and what goes out is debit. Normally we understand like that, but there are some differences. Okay, what comes in is credit and what goes out is debit. That is what normally we understand. Okay, so there is a debit and this is credit. So suppose that I said this example, Rubik's Cube, if I am exporting this item to US, so this is the transfer of I should sell this product, or I should transfer the ownership from my hand to some other person. Okay, so I am transferring this one to another country. Okay, so there is a transfer of one tangible items. So okay, in reward I'll be getting some dollars. So there are two transactions. One is some merchandise or commodities I am transferring from one country to another country. Instead of that, okay, I am getting some reward, I am getting some price. It might be in dollars. Okay, so that is a nominal, or in money terms there is another transactions. So for each economic transactions, there will be two sides for that. That's why we are saying that it's double entry bookkeeping system. In one side it will be debit, or another side it will be credit. Okay, so credit and debit will be recorded in this balance of payment. That's why we are always says there is a double entry bookkeeping system. So there will be two transactions for each any transfer of any items. There will be two transactions. So that's why we have double entry bookkeeping system. And in normally this commerce people they are following the credit will be written in the right side and the debit will be written in the left side. So this is the general practice. But when we are talking in balance of payment, it is just opposite of that. Credit will be in the left side and the debit will be on the right side. So this is the difference between normal accounting and also the accounting of balance of payment. In the normal accounting, credit on the right side and debit on the left side. But when we are coming to the balance of payment, credit will be on the left side and the debit will be on the right side. Okay, so you should understand these two things. Always the balance of payments are kept or adopts a double entry bookkeeping system. So for each transactions there will be two sides, debit and credit, each will be recorded. That's why we are saying it's a double entry bookkeeping system. And in the balance of payment, it will be just opposite of normal practice of accounting. Okay, normally we understand that what is debit and what is credit. We normally understand what comes in is credit and what goes out is debit. But there is some difference. If we are going into detail, in the commerce, we know that there are three accounts. One is real account, another one is personal account, and third one is nominal account. So according to these three accounts, this credit and debit will be different. Okay, so this is known as golden rule of accounting. Golden rule of accounting. Okay, so in the real account means it can be any tangible or commodities item, export goods or import goods. Okay, the real items, not the nominal, not in money terms, but the real items or the real account, debit what comes into the business, debit what comes in. Okay, but the credit what goes out from the business. Okay, it is just opposite of nominal account. In nominal account you can see that debit is the expense or loss of the business, or debit is the what goes out. It is correct. Then credit is what comes in, or credit the income or the gain of the business. So what comes in is the credit, what goes out is the debit in the nominal account. Generally we say this formula, but in the real account it is entirely different. It is just opposite of nominal account. Debit what comes into the business, then credit what goes out from the business. Okay, then there is a personal account. Personal account means it can be a transaction between two persons. Okay, so in this case, debit the receiver. If I am receiving the money, so I am the debitor, or I debit the receiver and credit the giver. If I am giving the money, I am the creditor, or I am the credit will be recorded in my name. Okay, credit the giver and debit the receiver. So these are the general rules, or we can say the golden rule of accounting according to these three accounts: real account, personal account, nominal account. So according to this, credit and debit will be different. So you should not be mistaken. You should not say that all the what comes in is credit, but it depends upon what kind of account it is. Okay, however, we can say some of the examples. Suppose some merchandise export. I said the example, Rubik's cube I am exporting to US. Then is it a credit or debit? What goes out is in the real account it is debit. Sorry, it is credit. Okay, if I am sending, if I am transferring the ownership, or if I am exporting this item, it is a credit to me, it is credit to our country. And if I am importing some item, if I am importing this watch from some other country, so it is a debit item. Then what about the transportation and travel receipt which we are getting? Okay, transportation and travel receipt which we are getting, it is coming in nominal account, and we are getting the money. What comes in nominal account, it is credit. What goes out in nominal account, it is debit. Transportation and travel expenditures, it is debit items. Then income received from investment abroad. So we have made some investment abroad, then we are getting some income. So in monetary terms it comes in, so we will be included in credit. And if income paid out, then we can say that it is debit. So according to that principle, we can divide all the transaction into debit or credit. Okay, that you can see other examples also. Okay, now what are the different components or accounts of balance of payment? Now we got the idea what is balance of payment. It is all the transactions recorded in any in any year or any particular time, normally a year. So what are the components or accounts of balance of payment? There are different accounts like current account, capital account, and thirdly official reserve account. Now normally we may not heard this account, official reserve account, or it can be said as official settlement account. Okay, then in the US it is also known as account of financing of surplus or deficit. Okay, it is the account for the financing purpose of surplus or deficit. In US it is known like the account of financing of surplus and deficit. Then the fourthly, we can say that it is not an account, but it is also part of balance of payment, errors and omissions. Okay, so these four are the part or the component of balance of payment, or we can say accounts of balance of payment. Okay, firstly we can say about the last one, errors and omissions, because it then we can go into the detail of other accounts. What is errors and omissions? Errors and omissions means just some mistakes. When we are calculating and when we are adding all the data of balance of payment, there might be some possibility of mistakes and there might be some possibility of some omissions. Then this kind of data is included as errors and omissions. Like some kind of short-term capital inflows and outflows. Some of the countries, they are including, they are converting this short-term, volatile inflow of capitals for the short term. If it is for short term, then generally some of the countries are included in errors and omissions, not in capital account. And some of the data might be missing, or there might be some mistakes in the data. So for the adjustment purpose, we might be including some debit items or credit items that can be included in errors and omissions. Okay, so that is all about the errors and omissions. So if there is a mistake in the data or if there is some missing, so we will be adding some credit or debit items in errors and omissions. Then what about the other three accounts which are more important? Current account. Current account is a country's trade balance plus net income plus unilateral transfers during a given period of time. So the three things are included in the current account. First one is trade balance. All exports and imports, whether it is invisible item or visible items, it will be included in current account. all the trades, all the export. So exports of goods and services, everything is included in the current account. Okay, that is the first thing. Then secondly, net income. Okay, net income means it can be normal income, normal salary or anything, or it can be asset income. Asset income means suppose that we are making some kind of investment abroad. So it is investment is included in the capital account, but the income from that investment, it is included in current account. Okay, so investment is in capital account, but the income which is generated from this capital, from this investment, it is included in the current account. So it is a net income is included. It can be normal income or asset income. It can be salary or wages, or it can be anything. So all are included in current account. Then thirdly, unilateral transfers. What is unilateral transfer? Unilateral transfers means one side transfer. Suppose it's like a gift. If you are giving some gift to abroad, we are not receiving in return. Okay, so that kind of transfers is included in unilateral transfers, like gift, donations, or personal remittance, or other one-way transactions are included in unilateral transfers. Suppose one country in some kind of disasters, okay, or in some economic crisis, so other country will help them, okay, and they can give some donations for them, or they can give suppose that one country is giving some gift to other country. So all are included in unilateral transfers, and this unilateral transfers is included in current account. So current account, you should understand that it includes three things. Trade in goods and service, it is the largest component. Okay, all trade and in goods and services. Then net income, then unilateral transfers. Net income, you should not be mistaken, because all FDI and FII comes in capital account, but the income generated from that, it is included in current account. Then what is capital account? Capital account involves inflow and outflows relating to investment, short-term borrowing lending, and medium or long-term borrowing and lending. All the investments are included. All the investment and all the borrowing and lending are included in capital account. Okay, because it is a capital inflow and outflow. Okay, so all the investments are included in capital account. So when we are talking about the capital inflow and outflow, normally it is it might be direct investment, like in plant and equipment, or it might be direct portfolio investment. Okay, direct portfolio investment means investment in assets like equities and bonds. So we will be dealing what is FDI and FII in detail, or FPI we will be dealing in detail. But so the direct FDI or the direct investment, it is in plant and equipment. Okay, FII or FPI, it is in equities, bonds and all. So all this investment includes in capital account. But you should understand that income generated from this investment, it is included in current account. Okay, then in the capital account from 1999 onwards, capital account is known as financial account in US. So they call a capital account as financial account. So all are these all are the part of capital account. Then finally, official reserve account. So there are two accounts, that is a major two accounts, current account and capital account. Now third one is official reserve account or official settlement account, or thirdly international liquidity account. So in the name itself it is clear. Firstly, official reserve account. I mean, each country will have some kind of reserves, right? Each country will have some kind of dollars, some kind of euro, or any other currencies, or they might be having some gold. Okay, so this is known as official reserve account, and it is also official settlement account. If there is a surplus or deficit in other account, in a current account or capital account, each country can utilize these reserves. That's why it is known as official settlement account. Okay, thirdly, it is also known as international liquidity account, because it is the liquidity for the transaction purpose in international level, and all the country might be having some reserves in organizations like IMF. So this is also the part of reserves. So it includes the changes in nations' liquid and non-liquid liabilities to foreign official holders, and the change in the nation's reserve assets during a year. Foreign official holders means the organization like IMF. So each country will have some kind of liquid and non-liquid liabilities with them. Each country will be keeping some amount of money there, and they will have some liability there. So that liability first. Secondly, change in nation's official reserve asset. As I said, there will be some kind of reserve for us. In India, we will have some euro and dollar, and some kind of gold we have. So these all include official reserve account. So there are three accounts: IMF, SDR. Mainly we have a liability, or we have some kind of reserves in IMF. So we will be depositing in IMF SDR. What is SDR? Special drawing rights. Okay, and there will be some reserves as dollar or any other monetary gold. So each country's apex body or central bank might be having some kind of reserves and gold asset. So all this include in official reserve account. Collectively, it is known as a reserve account. So what is SDR? SDR is special drawing rights. So it is like a reserve asset created by IMF and allocated from time to time to the member countries. So it is a reserve in IMF, and it is allocated to each country. It can be used for the settlement of, it can be used to settle the international payments between the monetary authorities of two countries. So normally this SDR is used for the settlement purpose, settlement of any transaction between the countries. So this SDR, it is just like a currency of IMF. So this is also part of official reserve account. So I think you got the point. So the mainly two accounts, capital account and current account. So if there is a surplus or deficit, we will be explaining what is deficit and surplus. If there is a deficiency for a fund, so we will be taking from official reserve account. If there is some kind of surplus in that account, we will be putting that money also into the official reserve account. That's why there is another account as known as official reserve account or official settlement account. Okay, I think these concepts are clear for you, and in the next video we will be talking on what is balance of payment, and there are different balances like trade balance and balance of payment in accounting sense, balance of payment, basic balance and all. So we will be discussing that. Thank you for watching this class.